You know, the biggest names in finance are currently predicting a massive Bitcoin bull run. But here's the secret, and it's something most people completely miss. The reasons they're predicting this explosive growth might actually really surprise you, because it has almost nothing to do with what you'd expect. We aren't talking about everyday retail investors jumping in or social media hype. No, we're talking about a quiet, highly calculated mobilization of institutional capital. Welcome to this explainer. I am so thrilled you're here today because we're going to decode exactly what the smartest money in the room is doing right now. Look, it's incredibly common to just assume that the crypto markets are driven entirely by everyday day traders, right? But if we actually look at the data and if we listen to what the absolute heavyweights at major conferences are saying right this minute, we kind of have to pivot our entire understanding. The reality is that massive institutional forces are quietly gathering. We're talking billionaires, corporate leaders, and even high-level government officials, and they are all aligning on a very specific thesis. To really grasp why this matters to you, we have to look at the staggering numbers operating behind the scenes. $4 trillion. Let that sink in for a second. That is the staggering scale of newly created digital credit that prominent financial figures, like billionaire Arthur Hayes, believe will act as the actual underlying catalyst for the next major market move. He genuinely believes this wall of liquidity is gonna outpace nearly any other market force out there. So you might be wondering, how exactly does $4 trillion suddenly flood into the system? And more importantly, who is opening the floodgates? Well, to unpack that, we've got a roadmap for today. We're going to break this down into four key pillars: the digital credit boom, corporate treasury defense, the government domino effect, and finally, the ultimate inflation hedge. Let's dive right into pillar one, the digital credit boom, and how they're merging yield with Bitcoin. So, industry giants like Arthur Hayes and Michael Saylor are making this fascinating argument. They're saying the market's explosive growth isn't going to come from your average buying and selling. It's actually going to come from the rapid expansion of digital credit. Let's compare it for a second. Think about traditional private credit. It's a massive $3.5 trillion market, yielding maybe around 8 or 9%. But as Michael Saylor points out, it's totally illiquid, it's completely opaque, and frankly, it's often under-collateralized. Digital credit, on the flip side, it's highly liquid, it's fast-growing, and it's transparent. Think about it. If digital credit captures even just 1 or 2% of that $3.5 trillion traditional market, boom, it'll cause an absolute explosion in value. And here's why that's happening. Wall Street literally has an insatiable appetite for yield. As this quote perfectly captures, digital credit takes the incredible power of Bitcoin and essentially marries it with the familiar, traditional power of fixed income. It gives the legacy financial system this highly efficient, brand new avenue to hit the higher levels of yield they are so desperately chasing. So they're lining up with trillions of dollars to participate. But hey, the credit markets, they're just one piece of the puzzle here. Which brings us to pillar two, corporate treasury defense, or protecting the balance sheet. This second pillar is really anchored by billionaire investor Tim Draper and his urgent, almost table-pounding belief that companies simply have to start playing defense with their cash. He actually illustrates this with this crazy anecdote from his childhood. Picture this. He's 10 years old, and his dad hands him a $1 million bill. Young Tim is, of course, ecstatic. He's thinking of all the toys he can buy with $1 million, right? But then his dad says, you can't buy anything with it. It was $1 million Confederate dollars. Because the Confederacy lost the Civil War, their currency heavily inflated until it literally became worthless paper. Draper uses this super memorable story to highlight the catastrophic historical danger of fiat inflation. The takeaway? A currency's value is absolutely never guaranteed to last forever. And because of that lingering inflation risk, Draper paints a pretty intense scenario. He envisions massive, retail-driven bank runs where everyday people start accepting and eventually demanding only Bitcoin. So in his eyes, it's actually highly irresponsible now for corporate leaders who manage a large treasury to not hold a 5, 10, or even 15% portion in Bitcoin. We're past the days of it being just a fun, speculative tech experiment. According to him, it is now a necessary shield to literally protect a company's balance sheet. Moving right along to pillar 3, the government domino effect. We're talking strategic reserves and clear rules. Okay, so if corporations are out there protecting their balance sheets, nations are definitely next up to the plate. Impartially speaking, we're seeing massive policy shifts right now. Patrick Witt, who leads crypto strategy at the White House, recently noted that the executive order for U.S. Strategic Reserve is already signed, and they are actively working through the legal machinations to make it happen. The realization of that reserve, that's domino number one. When the largest economy in human history begins actively acquiring this asset on the open market, it triggers the second domino, clear legislative frameworks. And that inevitably leads to what you could call global sovereign FOMO, fear of missing out on a nation-state scale. Other nations will scramble to figure out their own strategies and acquire their own reserves, creating this massive geopolitical chain reaction and an entirely new class of heavyweight buyers. And alongside the White House, we're seeing regulatory bodies shifting their stance too. Paul Atkins, the incoming SEC chair, has stated that regulation is actually going to be a boom for the asset class. The SEC is exploring new innovation exemptions, they're calling it Reg Crypto, to basically allow firms to experiment safely, build securitized tokens, and fundraise on-chain. Crucially, they're also pushing for Congress to pass the Clarity Act. Now, the stated goal here isn't to pick winners or endorse a specific asset. It's simply to provide clear, defined rules so that digital asset innovation stays inside the United States rather than bleeding offshore. For major institutional investors, a regulatory green light like this, that is the ultimate de-risking event. And that naturally brings us to our final stop. Pillar 4, the ultimate inflation hedge, where traditional finance officially enters the fray. So now we are stepping into the realm of pure, old-school, traditional finance, guided by the legendary macro investor Paul Tudor Jones. And he looks at this completely objectively, purely through the lens of math and historical risk. Obviously, gold is the traditional inflation hedge, everyone knows, right? But its supply actually increases by a couple of % every single year as more of it gets pulled out of the ground. Bitcoin's supply, however, is strictly finite, period. Because it's completely decentralized and physically impossible to create more than the fixed programmed limit, Jones argues it mathematically possesses the absolute greatest scarcity value of any asset on the planet. To him, it is unequivocally the best inflation hedge available today. But hey, to be totally thorough here, we absolutely must look at the other side of the coin. Jones is very objective about this, and he acknowledges two specific technological doomsday scenarios that could actually threaten the asset. First, in the event of kinetic or cyber warfare that heavily targets our electronics and our power grids, literally anything digital is at risk. That's strike one. Second, the rapid advancement of artificial intelligence could seriously accelerate the development of quantum computing. If a quantum computer becomes powerful enough, it could, theoretically, hack any bank or cryptographic network in the world. And honestly, understanding these risks is just vital for any serious macro investor who is weighing this digital asset against physical commodities. All right, let's tie it all together for the climax: scarcity in a world of abundance. When we take a step back and really zoom out, what are we looking at? We're watching a strictly finite, non-sovereign digital asset reacting to a global environment where governments are continuously printing immense amounts of fiat money. And just look at the incredibly diverse, powerful sectors of the economy that are all concurrently aligning on this one thing. You've got tech billionaires building digital credit, public corporations defending their hard-earned treasuries, the White House establishing strategic national reserves, and top traditional investors seeking out the ultimate inflation hedge. These forces do not always agree on much, but right now, they are fully unified in treating this asset as a foundational holding for the future. Which leaves us with one final and honestly pretty provocative question to ponder as we wrap up this explainer. You've seen the data. You understand the trillions in digital credit, the new corporate mandates, the shifting government policies, and the grand macro strategies. The smartest, most well-capitalized entities on the planet are taking their capital and quietly accumulating this scarce asset. So, knowing everything we just went over, do you want to take the opposite side of that multi-trillion-dollar trade? Are you really gonna bet against them? Definitely something to think about. Thank you so much for hanging out and exploring this massive shift in global finance with me today. Keep learning, keep questioning the status quo, and I will catch you in the next explainer.